Hello, and welcome to the Plain English Finance Podcast, the podcast dedicated to helping you make smart financial decisions. I'm your host, Trey Bino, certified financial planner and chartered investment manager. I'm a financial planner with TCU Wealth Management and Aviso Wealth. For more information or to send in your questions, check out the show notes at treybino.ca/podcast. If you want to learn more about me, start with episodes 1 and 2. So let's get into the 15th episode. So this is the first one. No, this isn't the first What We Do series, but it's the second one. So the last one we did was on managing day-to-day finances. So that would be out a few weeks ago. And this one is on investment products and investing. And it's a small part of, well, it's not, so I wouldn't say it's a small part of what I do. It's like 45% of what I do.
That's a pretty big amount.
It's a very large part of what I do for sure. But there is other things. So when people think, okay, they think of a financial advisor or financial planner, they think investing. And that is a super, super important part of it, but it's not the whole thing. But anyway, this little mini series thing is about what we do.
Yeah.
So, fortunately, we had two fun facts come in the mail recently. So we're going to review those two. Cease has never really looked at these. So it'll be fun to go through and hopefully pick up some things. I think there's actually a few lessons that we can take from them. So first off, the structure that we use, we follow the structure to manage for the cash flow management piece. So this isn't part of that piece, but in the cash management piece, we talked about basically bringing that income account back down to zero.
Yeah.
So what we're going to look at is not everywhere that it goes, but pretty much where that what's left over in that account goes to every single month, or at least part of that.
So when, just to recap that, it was our paychecks go into the primary.
The income account.
Yeah. Income account, primary income, I think it's called. And then our expenses are like everything we've budgeted for, sort of thing, like our expenses, our spending money, like a rise account, all that stuff comes out of that account. And then whatever's left over goes, what we're going to talk about right now,
goes into the investment piece. Yes.
Okay.
But for some, it might be paying off debt.
I already know that. I don't know. I'm saying, okay. I know that, but I was just...
Well, you have no idea where it goes. Let's be real.
Wow.
Am I wrong?
I know it goes into HS or HXS and GA something.
Yeah, exactly. Okay. So one other thing that we will touch on in future episodes is for taxes, for long-term tax planning, we still use that basic model that I spoke of, but Cease's money gets invested in an account just in her name, and mainly for long-term tax benefits, I guess, because I want to avoid as much non-registered funds in my name. So just as a general rule, at the beginning of the year, we max out our TFSAs, any RSPs that we're going to be doing, all of that stuff. And then everything ongoing just gets shoved into a non-registered account. So, well, let's deal with them both. So we're going to go through a fund facts. So we invest 100% equity. We don't hold any bonds or anything like that. So we have the full volatility of the markets to enjoy and to experience. There's been great times where that's felt like the greatest decision, and there's been times when that's felt like the really crappy decision. But overall, I'm very comfortable with market risk specifically. So let's talk about two of them. So, and this will actually get a little bit into my investment philosophy.
Yep.
So the first one there was, we're going to go through the dimensional one. Do you see that one there?
Yep.
Okay. Yeah. Grab the whole bunch. Okay. Perfect.
I don't know what that is. That's just the letter part. I
Okay.
think it's just these
Yeah,
two.
just them. Yeah. Okay, so Dimensional Fund Advisors is a company that I deal with a lot. It's where a lot of clients' money goes, and it is a people call them index funds, but they're not. That's not quite accurate. But they invest according to the efficient market hypothesis, which
Ah, of course.
of course, which basically means that uh, don't try to take bets and with individual stocks. Basically, so we're not paying for a manager to go in and buy uh, Bell over Virgin Atlantic. You don't actually have that here.
Yeah, we do.
Oh, you do. Okay. Not paying an advisor to pick between the two. We hold them both. We hold pretty much everything that is out there, like every company that is out there. And that historically, when you look at the numbers and the evidence, that's been a very, very consistent way to invest, and that's outperformed a lot of other things because of cost. So the first line there, you see the fund code, but you see the name of it at the top right hand corner. What's the name of this particular investment?
Uh, DFA World Equity Portfolio.
Yeah, exactly. Yeah, you're correct. Yeah, that's right.
Thanks for saying top right corner.
Yeah. So this is world equity. This is everything in there. Okay. So then we see further down, you see it where it says management expense ratio.
Yep.
Yep. Okay. So what does that say?
Oh, sorry, 0.31%.
Okay. So do you know what that is?
I'm going to guess, um, like I think it's something to do with the company, like because there's a management fee, I'm guessing, and that's the ratio somehow. I don't know what ratio, but somehow that's what it is tied to.
Yes. So this investment takes 0.31% every single year of whatever's invested in it, and that pays DFA, so Dimensional Fund Advisors, that pays that company to manage the money on your behalf.
Okay.
Okay.
Yep.
Um, if you scroll, if you look down, you see the big pie.
Yep.
Okay. So on the right hand side, name some of the things that or the left hand side, you could say top 10 investments. It only has 7, but name some of the stuff that's in there.
Some of the stuff is DFA US Core Equity Fund.
So what do you think would be in that?
I guess US core would be like companies that are very big in the US. I would guess.
Kind of, yeah. So remember I said it just holds everything?
Yeah.
That's what this is. It's just everything in the US.
Oh.
And then there's international core. That's also just everything internationally.
Like everything in the world? I don't understand.
There's 15,000 different companies in this portfolio.
Oh, wow.
Last time I checked. Between 15 and, yeah, I think it's 15,000 different companies in this portfolio. Yeah, it's a lot of companies. It is everything. That's very literally when I say
so when you're like,
everything.
I'm gonna invest in this, you're basically investing in everything.
Yeah, you're
in the world.
investing in the global economy.
Interesting.
Yeah.
Okay.
Don't take bets, right? Like the bet is that we as humanity will continue to make progress. And if we don't, probably dead anyway.
Bigger problems?
Yeah, pretty much. And this is why, yes, we're invested 100% equity, but the type of risk is really important. But anyway, international, and then you see Canada as well. So
Yep.
we have Canada. There's also real estate in there as well. But this is just a relatively cheap global portfolio of all the stocks. This DFA, so what they do differently than somebody like, have you heard of Vanguard?
Yeah.
Okay, because we own some of that as well. But the difference is that Vanguard, they have similar type of things, but DFA is tilted more towards small and value companies. So when you look at the data historically, small companies have grown more than large companies. And intuitively, that makes sense, but it's not the small companies that make the headlines. Right? So it's the big companies that make the headlines. But what do you think's easier? Taking a company from $10 million of revenue to $50 million of revenue, or taking a company from $50 billion of revenue to $1 trillion of revenue.
The
Right.
first.
It's significantly easier to grow in smaller companies. So intuitively, it makes sense, but it applies to investing. What we do find, though, is that small companies tend to be more volatile than larger companies.
Yeah, for
Right.
sure.
So
If you want the big growth, you got to be prepared for the.
the ups and downs that come along with that. Exactly. I'm okay with the ups and downs that come along with that. So hence we have them. But that is something that I talk a lot about aligning your time frame with the type of investments that you hold. That doesn't mean that there aren't ways to pick lower risk, like lower actual investment risk type companies within equity. So let's say your time period is really far away. I would still rather pick blue chip companies, which is maybe a phrase you've heard of.
I have heard of it. I don't know what it means.
Just means basically just means the large companies.
Okay.
The large, big companies, established companies. I would still rather take that approach and buy them than put it into GICs or bonds, right? Just because if the time frame is longer, I still want to own a company. But if I'm not comfortable with the ups and downs, maybe I pick to own Walmart instead
that's
of
exactly
a
what I was
smaller
thinking.
company, right? Yeah. But anyway, this particular portfolio is tilted more towards smaller companies.
But okay, so you say tilted more towards small companies, but if this is maybe this is a dumb question, but you said like the US core is like all of US companies. So how could it be tilted towards small companies?
No, that's actually a really good question. Okay. So if you had to pick a way to hold 100 companies, how much of each company would you hold?
Oh, I see. Wait. Oh, because these are. Sorry, ask that question again.
So I give you 100 companies that you have to hold.
Yep.
How do you determine how much of each company you hold?
How do I determine that?
Yeah.
I just want to make the most money, to be honest.
But how do you know that in advance? You don't know that.
I asked my husband, who's a financial advisor.
Okay. So people use something called market cap weighted. So the
Well, that's
bigger
what I
the
meant.
company, there's different ways to do it though. But the bigger the company, the bigger portion that you own, right? Of that group. Doesn't make sense. That's okay. I'm gonna bring up the S&P 500 real quick. Okay, so this is the S&P 500. I'll get you to grab that. Okay, so you will see there, I can't see anymore, but you'll see there a list of companies.
Yep.
Okay, it gives you like the top 10 or top 20. Does it say there?
It says NVIDIA Corp, Microsoft, Apple.
Okay, so next to NVIDIA, what percentage does it make up?
7.32 blah,
That's
blah,
fine.
blah.
Yeah. So in this fund, so this is a Vanguard S&P 500, which we also own some of, but that is the percentage of that company. So you put $100 in, $7 of it is in NVIDIA.
Okay. Yeah.
Okay. Keep going down the list. So
Then Microsoft, which is 7.0.
okay, so $14 of that $100 is now in those two companies.
Yeah.
Okay, keep going.
Apple 5.8.
Okay, so that's now 19%. Let's call it 20% within the first three companies. Okay, let's stop there. It gets worse, but so you put in $100. You think you're very diversified because you think you have. This is S&P 500, so that's 500 different US companies basically, but so far, you've put in $100 and $20 of it is only in three companies.
It's heavily weighted.
It's heavily weighted on the bigger companies.
Yeah.
So the difference between something like that and the dimensional is they tilt it away from it being so heavily weighted in the big guys to being a little bit higher weighted in the small guys, which means that maybe in a typical portfolio like that, the smallest companies in the S&P 500, there's no real small companies, but for argument's sake, let's say it makes up 5% for 1,000 small companies. Well, dimensional will increase it to 10%.
Okay.
So it's not huge. It's not saying that it's these,
It's not
hugely
like
tilted.
flipping the
No,
whole
no,
list around.
not at all. But it's just so you have more exposure there than you would do in a typical market weighted index fund.
Interesting.
Okay. So that yeah, that's the biggest difference between Dimensional and Vanguard.
Okay, I do have another question.
Okay.
Because I is Vanguard the exact same as S&P 500?
No, so Vanguard is a company that creates investment vehicles. So typically ETFs. They do have some mutual funds, but that's all they do. Is they just create the investment vehicle and manage the money. The S&P 500 is a measure of the top 500 companies in the US,
Oh, okay.
basically.
Okay, gotcha.
Yeah, and it's fine. This is going down a rabbit hole, but the S&P 500, people assume it is a passive index. It is not a passive index. So there are qualifications, and there's a group of people that determine whether companies get into the S&P 500 or not. And this is what actually happened with Tesla. Is there was a period of time when, because they weren't profitable, they didn't meet the guidelines for being in the top 500 companies, and it meant that when they finally did get put into the S&P 500, I think I can't remember, you can't quote me on this, but I think they came in at like number 20 or something. Like it was like they missed the first 450 odd places where they should have been in there, because it's a group of people that sit down and determine who gets added to this. So the efficient market hypothesis, which is what people inherently are investing in, when you go with index funds, you're kind of saying, okay, I think that all the information is baked into the price, and or at least should act accordingly. So that's how I'm going to choose to invest. And then they will say, okay, well, I'll pick the S&P 500, and it's like that
Because
isn't the same. That isn't picking the S&P 500 is not you investing in that capacity. Not to say it's a bad investment, but it is intellectually dishonest. You can't say, hey, I believe in the efficient market hypothesis, and then invest in the S&P 500. That's not a good substitute.
do people understand that
No,
label?
people don't at all. A great example, I was working with somebody, and they were putting together I was helping them put together a portfolio, talking about it, and they came back to me wanting to compare, and they're asking like the difference between an S&P 500 fund and a whole market US fund. And I know people will compare them. They are not the same. They are not, you're not picking, these are not apples to apples comparisons, because one of them is the entirety of the US stock market, which falls more in line to the efficient market theory.
Hypothesis.
Yeah. Versus the S&P 500, which are just picking the group of the 500 companies that this group of people think are the biggest companies and deserve to be part of this index.
Who are this group of people?
Standard and Poor's. Not going to get into that. It's
Is it a conspiracy?
No. It's just the people that put the index together, right? But yeah, it doesn't really matter. It's not the same, basically.
Yeah. Okay. No more tangent.
Yeah, I'll
Sorry.
get back to Okay, so keep going down. So next page.
On the back?
Yeah. See, it says the risk ratings. Let me see. Yeah. Okay, so read the top left-hand paragraph. It says, how risky is it?
You want me to read the whole paragraph?
Yeah.
The value of the fund can go down as well as up. You could lose money. One way to... Sorry, it's really dark right now. I'm struggling to see.
Okay, I'll read it.
One way to gauge risk is to look at how much the fund's return changes over time. This is called volatility. In general, funds with higher volatility will have returns that change more over time. They typically have a greater chance of losing money and may have a greater chance of higher returns. Funds with lower volatility tend to have returns that change less over time. They typically have lower returns and may have a lower chance of losing money. Risk. Oh, sorry.
Yeah, that's fine. So that's the measure of risk that we spoke about in previous parts. So that's
Like
just
episodes?
in previous episodes. So this fund, do you know what it's rated as?
Well, it's pointing to medium.
Yeah. So this is considered a medium risk fund. So as a general rule, because it is because it's based on volatility, I'm going to kind of give you a different measure
Hmm.
of risk to think about it this way. So an all equity fund that is investing according to the like a broad markets holding really big swaths of companies is medium risk. Like think of that as when people think in the, is that risky or not? Medium risk. Okay.
Hmm.
Not using volatility, just think it's medium risk. A company that is a group of like a fund or something that is investing in a group of blue chip companies. So they pick like 30 different companies,
And they're big companies.
big companies. That is a medium risk investment as well. Okay.
Yeah.
As soon as it's a group of companies and they're in only one or two industries, so let's say they're investing in mining companies, you are now jumping to, and they're small companies, you're now jumping to high risk.
Yeah.
If they're big companies, you're now looking at medium to high risk. Okay, if it's all in one area of the
Right.
market, I don't care what the area is. That's
Yeah.
the way that I would categorize that type of investment.
Yeah.
A balanced fund so balanced fund is like 60% of it's in equity and
Hmm.
40% of it's in like fixed income and bonds and stuff like that.
Yep.
I would categorize that if the equity part is in bigger companies or in index type investing, I would categorize that as low to medium risk when you're thinking about it. In the like medium term, long term, again, you're adding risk the longer bonds are not good for long term.
Yeah.
But I would say that's low to medium. Um, and anything lower than that, I low risk, I hate assigning. I do not like when people are looking for like a low risk investment, there is a ton of risk when it comes to because a low risk investment is going to basically be something that doesn't move very much
Yeah.
at all,
Like volatility.
which volatility wise, which means that you're taking a lot of risk with something else.
Yeah.
So I don't really assign anything to low risk. I would say the lowest I would realistically go if I was investing would be that balanced approach, low to medium. But we invest all equity, and this fund though is considered medium risk. But that means 2008. What do you think this type of fund would have dropped?
Probably not as much as other ones.
Oh, yeah, throw out a percentage.
Well, I don't know. Um, 20%.
We wish 40%.
Oh, I was close.
So what? So that means you had $1 million in there. That means that dropped to $600,000 at some point during that scary event, right? And that is what you have to be able to sit through when we're putting money into that. That's what I'm thinking in my mind is I have to be okay with that type of drop for me to put the money in there.
Yeah.
I am okay with that type of drop because the upside is significantly better. So the next part on that sheet, the lower part, you'll see annual increase dash decrease. You see that little graph?
Oh, yep. Yep.
Okay. So read back what you see there. Something like 2020. What did the fund do?
2020.
2020.
4.29%.
Okay. 2021.
21.39.
2022.
10.08.
No, minus.
Oh, sorry. Yeah, minus 10. I obviously did really well in math in school. Read
Minus
the
10.08.
Yeah.
2023.
Big drop. Okay. 2023 is 16.42.
2024.
18.5.
Okay. So
What happened in 2022?
that was when interest rates. Do you remember interest rates went up?
Yeah, like our mortgage and stuff.
Yeah, and bond prices. So bond prices dropped significantly. So that low risk investment type with a bunch of bonds in it went down in value a lot, and they're only just now-ish breaking even. And the equity markets went down at the same time. So hence 2022. A 10% drop in the markets, don't care. Sounds really bad. Every single year, pretty much, at some point in the year, we'll have a 10% drop. Whether that drop is in December and it gets recorded on this little graph, or it's in February and it doesn't get recorded on the graph because the recovery happens within the time frame, because this number is only from January 1st to December 31st.
So they don't figure out what it would be throughout the year?
This doesn't tell you what the route was. This doesn't tell you how low it went during the year or how high it went during the year and came back to, 2024, it says 18%. It could have went up to 30% and then back down to 18%. And you don't see that by the numbers.
Yeah.
But people forget that. And it means that when drops do happen and get recorded, it's a little bit scarier.
Yeah.
But I mean, if we suddenly decided to measure from September to September, the numbers would look very different, but the growth would have been exactly the same. So just something to keep in mind that, negative 10% drops, they happen almost every year, and it's at some point during the year. And yet the vast majority of the years you see landed positive. In 2020, we had a 20% drop, and it was up 4.3%. You would never have really known if you just looked at the numbers, but everybody remembers COVID.
Yeah.
So,
well, you'd be like, oh, COVID didn't really affect this very badly,
right?
If you just looked at this little chart.
But we all know it did. So yeah, and that's the reason why, even if I was, I think about it, okay, 2008 happened, it could drop a bunch, but the fact is, even if it did right now, you'd still be ahead, right? You'd still be up more than over that time, over the last 5 years, you'd still be up more than whatever you put into it 5 years ago, even with the drop.
Yeah.
And that's part of the reason why I don't hold cash.
And again, though, it's, what did you call it? Is it anchoring?
Anchoring bias, yeah.
Do you know what I'm talking about? Where it's like, even though you have more money from investing, you always like get stuck on the high number. It's like, I didn't make that much though. It's like, because you saw that number.
Yeah, exactly. If it's invested and it gets to $1 million, you are, and it happens a lot around whole numbers. Like, you are anchored to $1 million.
Yeah, you're like, oh,
and then
it went down to 900. No.
Yeah, and you don't sit back and think, okay, I actually went from $400,000 to $900,000. That's still a lot of growth, great growth. You think, oh, I went to $1 million, I was at $1 million and I dropped to $900,000.
I lost $100,000.
When in reality, that's the experience of investing, right? Which is why something that a lot of clients probably get frustrated with me at. So when somebody comes and they say, hey, I need more money than we had originally planned for, the way that what I do is I work out where I want them to be at every single year. And if they're over that number and the markets are up, I say, do it. Like, go spend the money, do it now. Because who knows what the future is going to hold. Yes, the market could continue to go up, but why take the risk when you want to do it? Go do it. You can afford to do it. But it just means that, so when the markets are up, it's like, I'm all for going and spending and doing the thing. As soon as the markets drop, though, then it's like I'm back to we set an amount, we have a specific amount that we agreed on it. We were spending because that's what I have invested in some GACs. Like it's like, no, this is this is how it works. So I feel like maybe they get a bit of a yo-yo trade depending on what the markets are at.
What version of tray we're getting today?
Yeah, it's like, because sometimes they'll come in, they're like, oh, I'm thinking of buying this $60,000 car. I'm like, yeah, I'll send you the money. Great, to go do it. Then other times it's like, we spoke about this. Maybe we should wait a year. So
you're like, this is what the numbers are saying.
Yeah,
I don't think it's a bad idea.
We've had a few drops in the last little while that has caused me to put the pause on some people's overspending, like more than we had originally agreed to. But so that's when you look, that's what that part is. And then on the last page, the main part is it gives you a breakdown of the fund expenses. So it says, for every $1,000 invested, $3.10 gets taken for expenses. Yeah, that's the management expense ratio. Okay.
Yeah.
So that kind of makes sense.
I think so. Yep.
Okay. So for this one, this is actually where I empty that account every single month, but I do know roughly how much is going to be in that account. So what we do is it gets set up. This chunk goes into this fund, and then what's left that isn't, I haven't already accounted for. So what's left in the account after this has come out, that then gets invested into various other things.
So you're like, okay, I know like our income is about this amount, but it does fluctuate slightly. So if you're like, I'm going to take this amount that's left, like let's just use $1,000 just for
Or let's say
easiness.
like, in that account, typically your income's going to fluctuate by $300 a month.
Yeah.
Let's say, I'm just throwing out a number. And you might say, okay, I think I'm going to have around $2,000 left in this income account. So I'm going to put aside automatically $1,500 of it. And then whatever's left, I'll send away.
You'll
So
like do it
I'll do it
yourself.
manually. Yeah.
Yeah. Okay.
Yeah.
Gotcha.
Yeah, exactly. So yeah, that's where that little chunk is that goes off into this one.
Hmm.
The other one, so you have it there as well. What's that one called?
The Global X. I don't know what, like, I do know, I hear you say these words. It's, I feel like, okay, I just want to clarify. I do know some stuff. Just sometimes I struggle to retain things. And I think that is the problem here. I do know that we're invested in Dimensional Global X, blah, blah, blah. Anyways, S&P 500
Okay,
index,
so
corporate
this,
class ETF.
okay, so a really important thing. Well, actually, let me back it up. What do you think this is invested in? This
Well,
isn't a
because
trick
it's,
question.
yeah, I'm like it's global. So global.
Or Global X is the name of the company. Like Dimensional Fund Advisors is the name of the company.
Oh,
So look at the other sheet, the
yeah,
dimensional one. So it's they lay them out pretty similar.
yeah,
So fund name is Global X, is the company name.
yeah. Okay, just wait then. Sorry. Um,
Say what you're thinking. Say it.
cash held for collateral.
Okay. A
What?
key thing that you need to know, everyone listening to this needs to know, if you do not understand it, do not invest in it. Simple as that.
Oh, well, I've broken that rule.
Well, you're not in charge of the rest of it. But simple rule. So if you're reading through, which you should be reading through at the minimum, you should be reading through the fun facts before you pick an investment or choose it. If you're looking at it and you do not understand it at all, you need somebody to explain it to you. If you do not understand it after that, do not invest in it. So this is the S&P 500, kind of, but it's not.
I don't like that.
Yeah, I know. And this is why a lot of people will buy something like this and they don't really understand what they're buying.
Yeah.
So I'm gonna read it to you.
Okay.
The investment objective of the ETF is to seek to replicate to the extent possible the performance of the S&P 500 index, net of expenses. The S&P 500 index is designed to measure the performance of the large cap market segment of the US equity market. The ETF may use derivatives such as swap agreements or multiple swap agreements to obtain exposure to its underlying index without investing directly in the securities that make up its underlying index. Yeah.
Super clear.
Yeah.
Makes a lot of sense.
So the reason that we are holding this is because it is corporate class. Corporate class just means, well, it's a more tax efficient way of investing. Or it can be a more tax efficient way of investing. So this basically buying this ensures to what we can do is that there's no ongoing distributions from the ETF, which means you're not having to pay as much tax as you go. But it does open you up to other types of risk. And one of these, in this case, is you're exposing yourself to index swaps. So they basically go to a bank, let's say, and they say, if we give you this much money, you'll give us an agreement that allows us to invest that's going to go up and down similar to what the S&P 500 is doing,
Oh my
basically.
gosh. I'm not gonna lie, this is like really.
Yeah. Do not buy something like this unless you understand the true risk, because the advice is different depending on what's happening in the world. Like I would always say, don't sell. Like you buy something like an index fund, don't sell it. Like if the markets are down, etc., no matter what's happening, financial systems are in trouble, etc., don't sell it. We've seen through history, just keep hold of it. You have the legal system to protect you to a certain degree.
Yeah.
When it comes to derivatives, where it is based on the asset, not the asset itself, completely different ball game. And my recommendation would be completely different if, depending on what was happening in the markets, not in the markets, depending on what's happening in the financial industry, my recommendation might be to sell something like this, even if it was down 50%.
Oh my word.
And that's, again, do not buy something that you do not understand.
I'm stressed. Is anybody else?
Well, part of my letter that you'd get if I die, part of it is to sell stuff like this,
Oh,
because
thank you.
I don't want you to, even if
You're
there's
like,
the tax hit and stuff,
this girl does not know what's going on.
I don't want you to have to deal with this.
Thank you.
But
That's thoughtful.
yeah, you're welcome. But something like this is, yeah, it's really useful. It's been a nice tax benefit for us to use. And I think the risk is worth it for us. Doesn't mean that's the case for everybody. So yeah, don't invest in something that you don't understand.
So I guess like, here's the thing. Here's where I like, for that advice, I would say, if I didn't have you, how do I put this? I'm just, because I struggle like to retain this. It's like you're telling me stuff and yeah, it kind of it makes sense. And then like I go about my life and I forget it because I never look at this stuff again or never think about it. It's like, how do you,
It doesn't mean you have to because I do the same thing with lots of different topics. I would say it doesn't mean that you have to ongoing remember exactly how it is or exactly what it is, but you need to understand how it works.
yes, but I feel like
But
that's,
you only need to do that once, and that's the benefit of making any like going through a good decision making process. Is you taking the information, you learn it there and then, you make a good decision on it, and then you move on. And you might not remember all the details, but at one point you got the details, you made the decision, you understood it, and you can stick to that decision
yeah.
because you have went through that process. The scary part is when you didn't go through that process and then you're like, well, should I be changing it now? Because you never went through the process of understanding it in the moment and making that decision.
Yeah.
So if it's something that you don't understand, don't invest in it. There are very simple ways to invest,
Yeah.
right? Like you compare that to, I didn't plan this, so I don't have it printed or anything,
Sorry.
but that other one that we looked at, where, so that's the S&P 500 as well, right? What's it invested in?
It says top 10 investments: Apple, Microsoft, Nvidia, Amazon.
So the way you explain that is, hey, you have this money, that's how it's invested.
Yeah.
Simple.
Easy, yeah.
Easy. Compared to,
When you're like, you walk into the bank and they have an agreement with it and it's mimicking the S&P 500. I'm like, what?
Exactly. Compared to what it says on what the top 10 investments are on that. Fun facts,
Yeah,
right?
cash held for collateral, which I'm like,
don't buy it. Simply put, it is not worth it for you to be buying stuff that you don't understand, especially because the world is so big and people think that, oh, well, the more money I have, the more complicated it should get. It really doesn't have to. You know what it really bugs me? The CBP investments, you know what they should have done? CBP, one of the biggest pension funds in the world, like CBP, Canada Pension Plan. And they just released their performance. And they have a ton of like these like private debt and like private equity funds and all this stuff in there. And when you look at the performance, they'd been better off putting it into a global index fund and just leaving it alone. And you're like, okay, so you employ how many? I don't even know what the size of their team is. Tens, probably hundreds of people to try to pick the best investments and this fun thing and that fun thing. And it would have been better off you just having one guy that just presses
a button,
buys the index. Like, are you kidding me? So again, keep it simple. Does not have to be complicated at all.
I guess the thing is though, you like, yeah, because I'm just like an average person, a normal person who is I'm not interested in this. Like, I would learn it if I had to for the benefit of myself, but it does not interest me. I'm not it doesn't give me anything. You know what I mean? Versus you really are like, you love to learn this stuff. You're interested in it. You like learning how things work and like those kinds of things, I guess. So I was just thinking, I guess the difference for you is this probably isn't all that complicated. You know what I mean?
Yeah, and I understand how it works and how it fits into us. I understand the risk we're taking. I also understand what would have to happen in the world for me to be concerned about it.
Yeah.
So yes, as I said though, we would still be in a great position if I didn't do that and we just bought the S&P 500
Yeah.
with that money instead.
Yeah.
Right? Like
This
these are
is
just
like an optimizing thing versus
yes.
which again is why I hate the optimizing like culture that we have, because people will look at this and be
I
like,
think
"Oh,
that
I
they should
have to
learn
do
and do
it.
it as well.
I have
Yeah.
to do it because I need to be optimizing. I need to save $500 of tax." It's like, no, you don't. Not for the cost of like whatever. Like maybe it is worth it, but if you can learn it and understand it. But if you're like me and you're like, I could do other things.
Other things better with it, better to do other things with your time, do those things.
Yeah.
Absolutely. Not worth it. Honestly, it really like there are so many very, very simple ways to invest and just to make it easy on yourself. If you why overcomplicate it unless there is some real value to it.
Yeah.
So one of the things that I do that can like maybe seen as overcomplicating it. So for example, this original fund that we held, this
Dimensional?
DFA 922. So I will hold like so they have the US core equity fund and then I will hold that separate than the international. So instead of putting it all into a portfolio, so a large part of our portfolio is already split out into Canada, US, international, which means that because we are 100% equity investors, stuff is always going on in the world. And I want to ensure that no matter what's really happening, I have somewhere to pull money from. So, and then I'll go in and rebalance it. Typically, I'll rebalance it through the money that, like, not the money that's automatically going in, but the extra stuff that is after that.
Yeah.
But that's a safety thing purely because we are 100% equity. If I didn't even want to go that far, I would probably get somebody else to do it and then just hold a bigger emergency fund, right? Like you can keep it very simple. It doesn't have to be complicated and really complex.
Yeah.
It's just, it can be really simple, which is why this account is actually where Raya's money is. So this is the dimensional one that's, yeah, I could make it all complicated and fancy and probably save, I don't know, 0.02%. Like very literally, that's probably what I could probably save, and it's just not worth it. I would rather that's Araya's stuff. I put it in there. Don't have to think about it. She's 10 months.
Yeah.
Figure that out in 18 years.
Yeah.
When she wants a car. Like it doesn't have to be complicated.
Yeah.
So yeah, so we use index funds. That's the way that we invest. I do have some mutual funds. Like I hold again small cap fund. I think if I'm truly going to try to make extra return, it's going to be in stuff that's backed by data. So small cap companies is where I've added. We have bought individual stocks. Some of it's done well. Some of it's not so great.
Yeah.
And that's part of the reason why I would say for a lot of people, and myself included, why? And I say it's very critically because I like picking into. I still go in every once in a while.
You
and
do
pick
look
an
at
individual
companies
stock
and
and like I enjoy researching them, etc. And I'm in that world, so a lot of different companies come across my desk, but ultimately I have to weigh picking this individual company over just putting it in the basic index. And I would say 99% of our portfolio is in low cost index funds.
Yeah.
And there's or at least groups. And then there's the rest that, I'll pick stocks here and there and have fun and enjoy it. But again, the index part of my portfolio has definitely performed better. Which is, and the thing about it is I've picked probably 15 different stocks that have done really, really well. But it only takes a few high conviction losers to not.
You're like, why am I doing this?
You're like, why did I do this?
Yeah.
Even if you did it right in the first place, maybe you have a wife that will convince you not to.
Hey, you don't
Anyway,
even tell the story.
moving
Okay.
on. Okay. um, so yeah, so that is pretty much that's basically the way what we used to invest. And I would say keep it simple. Like Vanguard have a great suite of like an whole market stuff. Like if you are wondering, do I buy the S&P 500 or do I buy just the entirety of the US market? Buy the entirety of the US market.
Hmm.
Like don't take the added risk. I know people in the last 10 years, the S&P 500 has definitely outperformed a whole market, not by much at all. But there are periods of time when the S&P 500 was well overinflated and large companies did terrible.
Yeah.
When you look through our history, small companies have outperformed larger companies.
Hmm.
So the math is there, the numbers are there. So if you do want to take a set it and forget it approach, that's very likely gonna give you good returns. Just buy whole market stuff. Keep it simple.
And
It's
be done
not.
with it.
It doesn't have to be in the. I would say this is very specific to the growing part of your life. I think when you get to relying on the money for income, you do need
Like
to
retirement.
not just retirement. Like for us, because we're 100% equity, it is a little bit different. Where I do need more options than just I could just put it into a global equity fund, like global index fund, and just do nothing else.
Yeah.
That would be a little bit risky for us because we're 100% equity and we don't keep a ton of cash or anything.
Yeah.
And if we need something, I have to go into the portfolio to get it.
Yeah.
Not to say it'd be a bad decision. It's just
It's
I'm
just
not
crappy
super
if the
comfortable with
markets
that.
are like
Yeah.
down at that time. Yeah.
So, but most people aren't invested that way. A lot of people will keep some excess cash or whatever to help with that type of thing. But yeah, just keep it simple. It doesn't have to be complicated. Just we don't hold. I have access to private equity stuff. I'm a accredited investor, so we can get into pots of here and there, and like keep it simple, low cost.
I'm very glad to hear
I
we're not doing that.
I saw somewhere it was Tom Brown. Dang, he's a big advisor in the US. Anyway,
Hmm.
he's on the TV a lot, and he showed a chart of venture capital is like private equity is the craze right now. Um, it's very expensive, and a lot of very wealthy individuals are putting money there, and they're being sold it as if it like helps minimize risk and risk measured by volatility because it's not
Mm.
on the markets. It doesn't get valued very often, which means it looks like it's
Just
doesn't move
going
very
up.
much.
Yeah.
Yeah. That's just not the reality of it. But it's really funny because the the funds have underperformed the company's stock. So it'd be better because they're so expensive and the companies make a ton of money. So you want to get into somewhere like honestly, if I had to redo and just my goal was to make as much money as possible, it'd be private equity
Wow.
because you can charge outrageous prices, underperform the markets, and still rich people are willing to give you their money. Like
They're
it's
like more.
you have advisors that are telling them, yeah, well, it helps with volatility, it helps with the ups and downs. It's like, well, they're taking like 6%, so it better. Like it's such an expensive. It's just pretty until, and that doesn't mean that it won't always be the case, but until we see evidence, like actual evidence, it's not something that I'm going to be holding or putting in clients' portfolios. It's just so expensive. I do think that will change. There's a new fee disclosure thing coming, CRM3, coming at the end of next year, I think it is, when everybody has to disclose the full fee of
Mm.
everything that is their clients are paying and everything on their
How is
statements.
this
I
just
know
happening?
don't
How
even
is
get me
this
started
happening?
on that. But yeah, crazy, right? But finally, that's coming, and I think people are in for. I think it's gonna be great. I think it's gonna be great for the industry. I think there's so many people with a lot of money sitting there in like RBC's balance fund paying 1% on $10 million, which is crazy. But they're not paying 1%. Sorry, paying 2 point something percent on a $10 million
Because they don't see part of
because
the fee?
they don't see they pretty don't see any of it, right? Because
Oh
it's
my
just in a mutual
word.
fund, just like a series mutual fund. So yeah, and they get a small disclosure somewhere that says you paid some, there was some
It's like
charges.
super fine print under
Oh,
a huge paragraph of
no,
text.
we've gotten better. Like, so now they had to disclose, as of a few years ago, they had to disclose the commissions. So anybody that, the company that received any commissions, that you got a statement out at the end of the year that shows that number.
Yeah.
But a lot of people think that's the only number, and they don't realize that it's probably at least double that,
Oh my
because
goodness.
people use very expensive stuff. And so, yeah, I think it's good. I think it's good for the industry, though,
Oh,
because
for sure. Because it's good for the people investing.
yeah,
Like,
yeah.
man, I'm not gonna lie. I'm very glad, like, okay, because I know you, I'm like so grateful that I have you because how do you like know all this stuff about the industry and how
You never would, right?
I
And
guess
that's
it's
why
like,
I
but
get,
to find it out later, you would be so
yeah,
like I would be so upset.
yes, and that's why I know I rub a lot of other advisors the wrong way, because I hold this industry to such a much higher standard than, I think it's very reasonable, but I hold it to a much higher standard than it is,
Yeah,
like
then the actual
than the
standard is
actual
set.
standard. Yeah, and I think that my standard should be the minimum standard. And I know that's like, it would mean a lot of people wouldn't be able to be in the industry, etc. But I think it's great. Like we see it on the news all the time. Like I read somewhere that somebody was barred from the industry for stealing money from a client, and
Oh
like
yes, I
it's
heard
like
that.
this type of, and I'm just like, how, like what in, I think that guy should go to jail for life. Like it's, you're telling me that, so you have your client's trust, so because it's a very specific type of relationship between you and clients, right? It's like clients that you work with for 20 years, 30 years plus years, right? And it's like, so you take that trust and like basically screw them, and you're
Yeah.
just like, how could you go to sleep at night? How could you like, what do
And
you,
it's like, aren't you making enough money? I don't know. Like, I guess if,
well, it depends on how they. There's plenty of people, plenty of advisors that are broke, that
yeah,
end up declaring bankruptcy, and also like it's crazy.
that is
And that's why I
crazy.
think it should be a s an. I mean, it should be an open conversation between, like, if clients wanted to know exactly the way I was invested, I'll show them the way I'm invested. I do it all the time. If
Yeah.
they want to see exactly the way I manage my cash flow, I show it to them. They want to see my will, I show it to them. Right? Like it's the trust has to go both ways, and I've got nothing to hide. And it's a little unfair because I view money so differently, so I don't, there's no, like, I don't have shame
Emotional
around or
tie.
emotional ties to it or anything. But I couldn't imagine working with an advisor and then finding out that they're going through bankruptcy, or
Yeah.
they're like struggling, etc. And you're like, who are you? So this person is the one I'm trusting to help me?
I guess
What?
it would be, I guess, like, I'm thinking of other industries. Like, if you were going to a personal trainer and you're like, I need to learn how to, like, I want to be an athlete. Like, I want to train to be an athlete. And you go and meet this personal trainer, and they're like super overweight, like sick. You know what I mean? Like, can barely walk. And you're like, would you hire that personal trainer? No, because but you can see that.
And it's very different if you can't see it, right?
Yeah. Like, if,
Or even in that case, I could see if they had a reputation, but again, the reputation is like open, and like this trainer also trained LeBron James,
yeah,
and
for
you
sure.
know, for
It's
the last
like,
20 years. And yeah, then I'm going to trust the trainer that's now, yeah, he earned it. He did it in the
yeah,
past, he earned it.
yeah,
You can do that now.
yeah,
Uh, but you don't have that same thing with personal finance, right? Like
yeah.
so
You can't see
you can't
their
see that. You can't,
statements.
and
And,
all you go on, a lot of people, all you go on is like a referral. Well, again, you can't see that. There's nothing that you can.
and again, that ties it back to the like trusting people's advice and they have good motive, but it might not be the right decision because,
Yeah,
yeah, you might be like, oh, my mom worked with this advisor and like I love my mom and my mom's referred me to this person. So I trust my mom. It's like, yes, but maybe that's not the right person for you or whatever. Like you just don't have all the information, I
if your
guess.
mum was like a insider, like also an advisor, and they refer you to somebody that then I would say, okay,
Yeah.
you know, if they genuinely like same if your dad was LeBron and your LeBron was like, hey, go to this personal trainer. It's like, okay, I could,
Yeah.
I could get that. But that means they have a deeper knowledge, right, of the industry. Anyway, we're way off track.
Sorry. Yeah. Let's wrap it up.
Yeah, let's wrap it up. I think that's everything. For this one, that kind of gave you an idea of that. Again, you're not going to see any expensive mutual funds or anything like that, or expensive ETFs or anything. We use low cost index type mutual funds and ETFs. Keep it simple, and doing it over a long period of time makes a huge difference. I know a lot of people, you see these calculators, like I had one here that I was going to go through, but it's like it tells you like initial investment into an RSP, a regular investment of, I looked back and found, so I've been putting at least $400 bi-weekly into investments since I was earning $50,000 a year.
Wow.
Which is, I was actually very surprised.
Were you proud of yourself?
Yeah, I was like,
There
heck yeah.
Yeah. Good for you.
Heck yeah. I was like that's not much income to be putting that. That's a big chunk.
That is a big chunk for 50.
Big chunk. Yeah, 100%. But I was doing it, like did the calculator from, if you did that from 25 years old versus starting at 35 years old.
Mm-hmm.
So the calculator I want to show you. So somebody starting with $10,000, person one puts in $800 from the age of every single month, starting at the age of 25 and ending when they're 50. So 25 years of investing, they end up with a balance of $709,000.
Mm-hmm.
The second individual starts at 35 years old and doubles that amount. So it's $1,600 a month. Yep. What do you think they end up with?
I want to say like $500 or $600.
$540,000.
Yeah.
In order to catch up, they would have to invest about $2,100 a month.
Wow.
To catch up. And it still doesn't quite catch up. $2,150. $2,150 a month-ish. Yeah.
Wow.
To catch up. It just tells you the importance of time, and why when I'm talking about it, I'm like, just make no excuse. Just like I did, like we did, just start, right? It's like we could stop investing now, and it would take, like people always talk about, okay, I made these bad mistakes. How do I catch up? You can't. There is no catching up. It sounds sucky, but it's true. You can't catch up. Yeah. But what you can do is do the best that you can to make sure going forwards you don't put yourself further and further and further behind.
Yeah, like the whole thing of like the best day to start was yesterday, the second best is today. Like you just have to start. That's why you're always on. I don't want to call it my family, but I have a lot of like younger family members that were pretty close to, and like they're not all a lot younger than us, or like some of them are around our age, and you're like,
but I give them heck for it.
You do. Yes. You get them on their investments.
Start, because I'm like, again, this is like $800 a month, which is a lot for sure. But it's true of any amount, right? Like at $400 a month, you have a huge head start. And in order to catch up, like somebody starting 10 years later would have to put in $1,100. $1,100 a month by starting later. It's like, okay, well, you tell me which is harder, $400 or $1,100.
Yeah.
Like it gets really difficult to catch up.
I think people think, oh, I'll start investing when I get more income. But what really happens most of the time is they just spend more.
Yeah.
And then they never have the money to invest. So.
Exactly.
Because you're like, oh, well, I'm finally in this job and now I can have all the things I want now. Yeah. Anyway.
It's so difficult. You leave it too late and
just get into the habit.
Longer, I guess. Yeah, just start the habit. Make sure it's invested properly, because I've also met people that it's like, yes, I've saved, and I look and it's just been sitting in a variable RSP for the last 10 years. I met with somebody that did that the other day, and it was like his girlfriend or his future wife, his fiance, they might have even been married at that point, but was like, hey, dude, what are you doing? He had been investing, saving religiously into his RSP, and he had like, I think it was like $70,000 or $80,000 in this RSP that he'd just been putting money away into. And it was like,
He thought he was doing something.
and
like
you are doing what is better than nothing, but I mean, honestly, I'd have rather spent.
Oh, don't say that. Oh,
Because that money is like, I think took him like 10 years or something like that to save it.
oh.
And it's just like, oh, that'd be worth double probably.
No,
And it
don't
just,
say that. What if they're listening? They're
it's just
just gonna be
brutal.
so upset.
I told him. I'm that
Just-
guy. I told him. And it
You're
was like,
crushing spirits.
from here on out, we're doing it. You're doing it properly. But yeah,
Yeah.
it's sucky. But anyway, that's we'll stop this episode. It's dragging on. Okay, next episode is on our DSPs, so disability plans. So we will see you in that one.
Bye.
Bye. Thanks for listening to this episode of the Plain English Finance Podcast. Trey Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities offered through Aviso Wealth, a division of Aviso Financial Inc.